they used to call it a hockey stick. If the revenue projections are like going up like a hockey stick, maybe that's a red flag. Like, it's really, really hard to do that in most businesses. So if the revenue projections are not reasonable, then, it's a red flag. And if at any point you find something that you don't like, that's going to keep you from sleeping well at night, you just say no and you go find another opportunity. Cause I tell you, they are everywhere.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today's guest is bringing almost 30 years of real estate, finance, and investing experience to the show. We have a great conversation on how to really pick his brain to understand how he's vetting these operators. What kind of deals are going on? How did he make that journey from corporate America into real estate investing? And his experience ranges really across three different asset classes: self-storage, short-term rentals, and distressed mortgage debt. And really keying into where the niches are to create that opportunity for you to diversify and get into that next opportunity. Know which questions to ask. An amazing acronym we've got laid out here today is the S.A.F.E framework. Really cool. S.A.F.E framework. And this is all through the years and tears, whether they're tears of enjoyment or tears of the pain, that we're going to leverage his experience from. Everybody, please welcome to the show, Tom Dunkel. Tom, welcome to the show all the way from Pennsylvania today, huh?
Yeah, Brett. Yep. I am outside the city of brotherly love, outside Philadelphia, Pennsylvania. It's great to be with you today.
Awesome. Amazing. And we're not going to touch on it, but this time of year, the chaos of the politics and Pennsylvania being the swing state, I can't imagine how inundated you are with, I'm going to say crap on both sides. It's just flooding on you.
It's pretty nuts. And I can guarantee you my phone is going to buzz because I get all these random spam text messages and stuff. I'm going to get text messages and emails while we're talking today, guaranteed. About the election. So it'll be good to get it behind us.
Yeah. So we're recording this here in the end of 2024, literally 1 week from the presidential election coming up. Mm-hmm. And what's interesting to me, Tom, being a direct to seller, real estate acquisition person, I've played the game of cold calling, direct mail, text messaging, all of this stuff. I've been sued before, like it's chaotic, right? What's fascinating is that politics don't have to adhere to their own laws. They can text me all I want. I'm on the national do not call. For the listeners, I am holding up my beautiful cell phone here. I'm on the national do not call list on all of this. And yet they can just text me as much and call me as much as they want. How do you like that?
It's rules. What is it? Rules for thee, not for me.
Yeah, there you go. All right, enough of that stuff. Let's get to real estate, Tom. How about that?
That's much more fun to talk about.
Absolutely. So here we are rolling into a wonderful conversation. And I want you to kind of steer us in your direction because you have almost 30 years of experience in the real estate world, in capital raising, in finance, even in some debt purchasing type stuff, and mergers and acquisitions. Man, it's just there. So first of all, tell us a little bit about Tom.
Sure. Yeah. Well, when you say 30 years, I'm like, who are you talking about? It couldn't possibly be that long. I guess, the calendar doesn't lie. I got out of business school in 1995. So I guess I'm at, 29 years out of business school. In fact, I'm the chairman for my 30th, reunion coming up next year. So already, working, speaking of raising capital, reaching out to my classmates, trying to raise money for that. But yeah, man, it's gone by really fast. But, I did have a nice stint in corporate world. I was doing mergers and acquisitions in the aerospace industry, which was a total blast. I was surrounded by some amazing people. I sat next to Neil Armstrong for lunch.
Oh, wow.
He was on our board of directors. Sally Ride was on the other side of the table. She was the first woman in space. And then, ex-fighter pilots. My one boss was a Gold Glove boxer at the Naval Academy, did his tour in the Marines, and then went back to the Wharton School of Business for his MBA. So this is sort of the caliber of people that I really cut my teeth on when I started doing deals, back in the late 90s. And so I just loved that. And that's sort of carried through my entire career. And of course, when you're in corporate world, I was scraping and clawing to, climb the ladder. And then of course, if they decide to change direction or whatever, it's like, you can find yourself out of a job. So, that's what happened to me in 2006. I was with a company that was, growing really fast. And then, they decided, hey, we're going to focus on, kind of the internal operation stuff, which is not my strength. So I found myself fired, with a wife and a 4-year-old and a 2-year-old at home. And, it wasn't a great feeling. Here I was, working my butt off, trying to make a difference and put all my skills, to work best I could. But that was the third time in 4 years that I'd gotten laid off or fired or whatever. And I was just like, you know what? I'm done. I'm done. And so, 2006 is when I jumped into real estate. And of course, my timing couldn't have been worse, really. So, because those ensuing few years, we ran into the Great Recession, got crushed there. My little war chest of capital that I had saved up, that all vanished.
Wow.
And that's about the time I discovered distressed mortgage debt. And so my partner, Joe Downs, he had just come out of he was kind of a commercial real estate refugee. I was a residential real estate refugee. We met at a real estate investing networking event in downtown Philadelphia. And turned out we lived around the corner from each other. We kind of hit it off. He was looking to reinvent. I was looking to reinvent. We met at the bar around the corner from our houses where we lived. And we just started talking about things. I said, hey, I'm looking at this distressed mortgage debt industry. It looks pretty interesting. He says, you're effing crazy. I'm like, hey, maybe I am, but you're a smart dude. Why don't you go, do your due diligence, come back to the bar in 2 weeks and let's, tell me what you found out. He comes back to the bar 2 weeks later and he says, I think you might be onto something.
What year was this?
That was 2009.
Okay. So there was a lot of distressed debt.
2009.
Right.
Yep.
Yeah.
So fast forward to today, that business is known as U.S. Mortgage Resolution, and we've generated about $59 million of revenue in that business over that time period.
Wow.
We've transacted on, 12, 13,000 loans at this point. Anyway, so we've built a nice little business there. And it allowed us to do some other things. So we did some hard money lending. We were partners in a title company for a little bit. And then about 5 years ago, we found self-storage. So we said, hey, this is checking a lot of boxes. It's tax advantages, capital preservation, income growth. It's an evolving industry. It's highly fragmented. There are a lot of things that we really liked about it. So we decided to build a team and go take a run at the self-storage business. So now we've acquired 18 facilities, about $50 million of acquisition value, 4,000 something units across about 7 states. So we built a nice little business there. And then, that's kind of where we're at today. And I'm sure we'll get into it in a little bit. But I'm actually at the start of a new venture for myself, which we can talk more about later. But
yeah,
I'll take a breath.
Yeah, that's really an amazing jump of 30 years there, huh? You did a great job summarizing that too. One thing you mentioned in there, you mentioned that storage is highly fragmented. What do you mean by that?
Yeah, great question. So, a lot of people think, self-storage, well, that's dominated by Public Storage, Extra Space, CubeSmart, those big guys that you've heard of. And they are big. But the fact of the matter is they only control about 30-ish, 35% of the total self-storage market. So call it 65% or give or take 40,000 stores across the country are owned by onesie twosie mom and pop owners. So those onesie twosie mom and pop owners, they're not going to the industry conferences. They're not learning the best practices. They're not implementing the latest technologies. It's kind of a business that they probably built themselves, and they just wanted to get the units full. That's their big key performance indicator, right? Is, am I full? So because the last thing they want to do is have a fancy website where, you can rent a unit online and, they have to do a marketing campaign on Facebook or Instagram or something to try to fill empty unit. It's the last thing they want to do. So that creates some opportunity for a company like ours because we do know the industry best practices. We do have the latest and greatest technologies that we're implementing. And, we run them like a business. So we're not afraid to push rates, lose some customers, because then our marketing program kicks in and we're able to fill those units that have been vacated with higher paying customers.
Right.
And so that allows us to push revenue and push the net operating income of the facility. And when you do that, just like in any other commercial asset class, if you can increase the net operating income of that facility, all else being equal, you're going to be increasing the value of that property. So you can really force that appreciation. And so that's what we do here. We're a value add shop at Belrose Storage Group. And so that's basically one of the things we really like about it is that it is very, very fragmented.
Yeah. And in those investments, and I heard you mention before we started recording that you were more of an operator in these partnerships, and now moving into this new platform of Eagle Capital Investments, you are building off these years and years and years of relationships that you've built with the right people that you've already vetted. You've been through the cycle on several investments with these people, and now here you come to build this fund, right? So tell us a little bit about what Eagle Capital Investments looks like then as this turning point, as you're moving into your 30th reunion here.
Yeah, sure. It's super exciting, Brett. Over my years in the industry, in the real estate industry broadly, I've been a member of a number of different mastermind groups. I go to the meetings, I go to the conferences, and in that process, I'm meeting people I'm becoming friends with. And, they might be an operator in the mobile home park space or the oil and gas space or, apartment buildings, right? Or short-term rentals. There's just all kinds of amazing people I've met in my travels. And so I figured to myself, hey, why not take advantage of this? Because as an investor myself, at the end of the day, that's really what I am. It's why we chose the self-storage asset class. That's why we chose distressed mortgage debt. We also do have a short-term rental portfolio. It's why we chose these different things, is because at the end of the day, we're investors. Yeah, now we're operating some stores in the self-storage space. But for me, especially, like I've always thought of myself as an investor. So here I am, meeting these amazing operators in these other asset classes, these other areas. And I figured to myself, hey, why not take these relationships out to my network, out to my world? Because I just feel very strongly that investors out there, especially investors who have reached a certain level of net worth, we call them accredited investors, right? So when you reach that certain level, you need to start thinking about things other than stocks, bonds, and mutual funds and just, stuffing your 401k with as much as you can. You need to start diversifying into truly, what I think of as truly diversified assets, which would include, a self-storage facility in North Carolina or a mobile home park in Tennessee. If you can become a part owner through your investment process of those different kinds of assets, now you're really diversifying your risk. Your financial advisor will tell you that, diversification means, small cap, mid cap, large cap, or value and growth, or blended. When the stock market crashes, and I've lived through several stock market crashes at this point, they all have a correlation of 1. They all go down. It doesn't matter, right? So that is not diversification. Diversification is when you're starting to invest in these other asset classes outside of the public markets. These are private offerings, and they're out there all over the place. And so I'm bringing that kind of experience, that kind of passion, that kind of mission to Eagle Investments. And so I'm just now launching my fund, and I'm really excited about it.
So Eagle Capital Investments as a fund, is this going to be like a fund to fund, or then will you go into syndications based off the fund kind of scenario?
That's exactly right. Yeah. So I'm targeting $50 million for next year to raise. And so as I'm raising that money, I'm going to be deploying it into the syndications of my trusted operating partners that I've gotten to know over the years. Interesting.
And for you, all of these years that you've built your own portfolio, and it sounds like you've done so much, and it's had to have generated so much money. Why? I mean, why do you need to keep going? Why?
Brett, it's such a good question, because honestly, I could retire right now if I wanted to. I'm 56 years old. I've built a couple of nice businesses. They're throwing off, plenty of money for us. But I feel at this stage, like that would be such a waste. Mm-hmm. I really am adjusting kind of my mindset, my perspective to wanting to really help these operators that I've gotten to know, who are like my friend Bryce Robertson. I mean, I don't even think he's 40 yet, right? But he's building this great business. So I want to help him grow his business by raising capital for his projects. And then on the other side, I feel like I've accumulated so much knowledge about how to reliably and predictably build an investment portfolio through these private offerings that, I feel like I need to take that to the world. I need to take that to a community of investors who, would just follow along with me. Cause of course, I'm going to be investing my own money in these deals as well. And so, there's only so much golf you can play. There's only so much, music you can play. We were talking about playing in bands, before we hit record. There's only so much travel you can do, right? So I'm shifting my kind of mindset towards much more of kind of a mentoring and coaching, but also, kind of a unofficial investment, advisor.
Yeah. And that makes sense. I mean, when you have skin in the game too, and I hear this a lot doing, something similar. When you have skin in the game, there's more care or attention to each investment decision that you make as well too. You mentioned reliably and predictably build this stream or this source of income. And I've seen before you've mentioned the S.A.F.E method for passive investing. Is that kind of what you're referring to there? What is S.A.F.E?
Yeah, exactly.
It's an acronym, right?
It is, Brett. Yeah. Thanks for bringing that up. Yeah. So, my whole thing is that you don't need just stocks, bonds, and mutual funds, kind of like we touched on earlier. If you want to build a reliable, predictable portfolio that's going to have tax advantages and just really smooth out your risk, you need to include these other types of investments that I call private investments in the mobile home parks, the self-storage, the apartments, et cetera. And how do you go about doing that? Well, it can be a little daunting for someone who, maybe you're a physician, and you're hunkered down, building your practice, you're doing your thing. Well, you don't have time to go and find, the Bryce Robertsons or the Matthew Owens of the world, or the, Hunter Thompson, all these operators that I've gotten to know over the years. They don't have time to do that. Right. So, but if they could just have a little bit of a framework, so they can start thinking about, okay, here's some steps I can take to get my exposure to those types of investments. That's what the S.A.F.E method is. So, of course, first you have to have your goals, right? You need to know, like, what am I trying to accomplish with my investment portfolio, right? Most people are looking to either, generate income, generate growth, generate or capital preservation, right? I mean, as you become more and more wealthy, you're probably maybe less interested in some huge upside You might be more interested in, hey, I want to just make sure I don't lose, right? With a little bit of gain would be great. And so, the beautiful thing about real estate is it covers all those bases. If you're buying Apple stock, that's a growth play. It doesn't pay a dividend. There's no tax advantages, right? And it could go up and down. So it doesn't really suit your capital preservation needs either. But if you invest in a good, solid mobile home park, for example, it's on real estate, right? So it's not going to zero like my internet stocks did in 2002. It's going to generate income. It's going to grow in value over time. And during that time frame, you're going to get these tax advantages through depreciation and accelerated depreciation. So, the S.A.F.E method, just real quick, is an acronym. Of course, investing isn't safe. I always have to throw out that disclaimer. But if you use the S.A.F.E investing method, you can eliminate some risk. So S stands for sponsor. Who is the dude that you're giving your money to, right? What's their background? What's their track record in this asset class? What does their team look like? Just all of those kinds of things, right? A is for asset. What is the asset that you're actually investing in? I love asking like crypto investors, like, what is the asset you're investing in? And can you explain it to your mother? Can you explain it to your young child? I can pretty easily explain self-storage, to my mom, right? So it's important to understand the asset that you're investing in and really understand it, because when you understand it, you understand the market, you understand what's going to impact the value of it up or down. And then that helps you make a decision as to whether it's going to be a good investment. F is for financials. What are the financial aspects here? What are the returns projections? What are the revenue projections? Are they realistic? Has the sponsor delivered those kinds of results in the past? So if, they used to call it a hockey stick, if the revenue projections are like going up like a hockey stick, maybe that's a red flag. Like, it's really, really hard to do that in most businesses. So if the revenue projections are not reasonable, then, it's a red flag. And if at any point you find something that you don't like, that's going to keep you from sleeping well at night, you just say no and you go find another opportunity. Cause I tell you, they are everywhere. Mm-hmm. And finally, E is for exit. How do you get out of this thing? It's not like you can go to schwab.com and click and sell your position in a Belrose Storage Group syndication deal. It just doesn't work that way. So as an investor, you need to know that your money is going to be tied up for 3, 4, 5 years, maybe longer if it's a development deal, maybe shorter if it's a different type of opportunity. But so that's in a nutshell, Brett. That's the S.A.F.E investing method. So we have an ebook that just kind of gives those questions. Of course, it's not an exhaustive list of questions, but it's enough questions to kind of get the investors' wheels turning. So at least they have a good feeling about, that they're getting into an investment that they understand, right? And that's really the key, is you want to invest in things that you understand. I don't understand blockchain. I don't understand, there's a lot of things I don't understand. So I try to steer clear from those. It goes back to the old Peter Lynch book I think I read back in the 80s or 90s about One Up on Wall Street, I think it was called. And it's just basically it's invest in what you understand. And so that's what the S.A.F.E method is hoping to help folks with.
Yeah, no, it makes sense. I like it a lot. The hockey stick red flag warning, I like that on the projections. And what I call the fluff forma. You got the pro forma, and I always call them the fluff forma because everybody's conservative. Yep. Everybody's
exactly. Oh, these are our conservative projections. Yeah.
Hey, on this journey, what's the biggest mistake that you've made when it comes to investing, whether in a syndication or as an operator? What's the biggest mistake that you've made, and what's one takeaway or one thing you've learned from it?
Yeah, great question. And actually, that's how the S.A.F.E method came about, because I made a ton of mistakes in my journey. So I was like, man, I got to get these down on paper, hopefully save some other people some heartache. And in fact, I lost 50 grand. I had a guy steal $50,000 from me because I didn't ask those questions. I didn't Google it. Now, look, in my defense, this was in the early 2000s and Google wasn't as much of a thing as it is today. And there certainly was no AI. So it wasn't like top of mind to go Google. But had I Googled this dude's name, I would have seen that he had done a bunch of bad stuff and I would have never given him a penny. Right. But yeah, so that's, I guess that's number one. No, there's a few things. Another one would be, as an investor, you want to find those kind of niche opportunities. So like when we found distressed mortgage debt, I was like, when you talk to people about it, if they look at you and, that's crazy, or yeah, you shouldn't be, that's stupid. You're going to lose all your money. Sometimes they might be right, but sometimes they might just be overlooking an opportunity that other people just aren't seeing. And that's what happened with us in the distressed mortgage debt business was as we listened, because we did, as we were kind of building our business and talking to people out there, we talked to some real estate attorneys and some foreclosure attorneys. We were trying to really understand the asset class. And a lot of them were like, you guys are crazy. But then a couple of them were like, hey, you know what? You might be onto something here. And another guy he's a capital raiser, fund manager guy. He was like, you guys are going to make a lot of money. So, you got to look for those kind of niche opportunities. That's where I've been able to find the best bang for the investment buck. Yeah, no, that makes a lot of sense. And now you've converted all of this stuff into this new fund, which you're just opening, and you're raising capital currently. The listeners can find you at eaglecapitalinvestments.com. It'll be in the description, but it's eaglecapitalinvestments.com. And go ahead and connect with you there. And just get rolling. Like on the front side of this turn, rolling into an investment fund, building and bringing this back, giving the opportunity back to everybody else to basically grind off of your years of tears. Yes. Right. Well said. Yeah. Yes. There's been many tears. There's been tears of joy in there too. But certainly a lot of tears of sadness for sure. Yeah, absolutely. Well, Tom, thank you so much for your time today. It's been a blast and dipping into the experience there a little bit, and just thank you for your time. Yeah. Thank you, Brett. And to the listeners out there, I mean, like I mentioned during the show here, I'm definitely in kind of a mentor coaching, I just want to help out. So by all means, reach out to me if you just want to talk about, Eagles football or playing guitar or golf or investments. I'm happy to chat with anybody about those things. So that's awesome. Yeah. And just kind of like summarizing everything here, it's just coming back down to, you don't have to be a professional to do this. You don't have to know, you don't have to have a finance degree, a business degree. You can keep your one thing the one thing. And as a physician, whether you're in training, still in business, or you're scaling your real estate and looking to maybe diversify a little bit, getting yourself around the right people is really important, because knowing the right questions to ask can save you those years of tears. You're not going to avoid everything. There's no such thing as a 100% guarantee. And if you are, that's probably if you see one, that's probably that person you should have Googled in the first place. But to mitigate some of that risk, using that S.A.F.E platform, looking at the sponsor, vetting them out, looking at the asset, looking at the financials. Do they make sense? Watch out for that hockey stick. That's the red flag. And what's the exit? Is it reasonable? And does it align with your values? In the world of inefficient investments, there are efficiencies. I don't understand why they call it that, but you can find those efficiencies leveraging relationships with the right people. This is the Real Estate Mogul MD.